So we are doing a sum which involves ratio analysis, where you have to comment upon the inventory turnover ratio, the trade receivables turnover ratio, the trade payables turnover ratio, and this is a past paper question of March 2019, paper 22. So read the question. The financial year of LW Limited, this ends on 31st of January, and I have the information available. In 2018, 2019, some inventory turnover ratio is given to me. Trade payables collection period is given to me. Trade receivable collection period is given to me. I have to find the current ratio of the current year, and I have to find the quick ratio of the current year. The first thing that they are asking me is to comment on the change in the inventory turnover ratio. What does the inventory turnover ratio show us? The inventory turnover ratio tells us how efficient are we in converting our inventory into sales. If we have a high inventory turnover ratio, that means our inventory is getting converted into sales very quickly. That means as soon as I buy my inventory, I am converting it into sales. If I have a low inventory turnover ratio, it means my inventory is taking time to get converted into sales. Now, if I see over here, last year, my inventory turnover ratio was 9.45 times. And the inventory turnover ratio has reduced from 9.45 to 8.17. That means last year, my goods were sold more better or more quickly compared to the current year. So I need to comment on the change in the inventory turnover ratio. It means that inventory is not sold as quickly as compared to the last year. Okay, inventory turnover ratio has decreased from 9.45 to 8.17 times, and it may be as a result of slowing down of my sales activity. So I just need to comment on the change in the inventory turnover ratio. So if I see, it means that inventory was not sold as quickly in this year because here the turnover is less. The inventory turnover has gone down from 9.45 to 8.17. It may be because of slowing down of my sales activity. I need to write any 2 points over here. Next question. State 2 effects of change in trade payable payment period. What does the trade payable payment period tells us? It tells us in how many days we pay our trade payables. Our trade payables payment period tells us that in how many days I am paying my suppliers. If you see, I was paying my suppliers within 40 days of my purchases in the last year. Now I have delayed the payment by more 13 days. Now I am paying them after 53 days. That means I am paying my trade payables very late. I need to know the effects of these changes. If I pay my trade payables late, it means my suppliers will not give me cash discount. They will bar me from giving me cash discount, so I will not be able to obtain cash discount. There may be a possibility that my relationship with the supplier may be damaged because I am paying him late and late and late. He will stop trusting me. He can also charge me interest on late payments. So I need to know any 2 points over here. Okay, the changes. How can we comment on the changes in our ratios depends upon our knowledge. We should know what each ratio means. Now the next question is, I need to comment on the change in trade receivable collection period. I used to collect from my trade receivables in 29 days after sales. Now I collect later. That means I am collecting 4 days later than before. What does this mean? It means that my credit customers are taking longer to pay. Okay. If they are taking longer to pay me, money is not available for me for other purposes. And there are chances, if they pay longer to me, there are chances that I may have bad debts. So the reasons, the change represents that my credit customers are not paying me money on time, and there may be chances of bad debts, or maybe my credit control is very poor that they are paying me late. If my customers pay me late, it means that I will not have cash flow in hand and money is not available for further payments. Now the next part. They have asked me to calculate current ratio. What is the formula for current ratio? Current ratio means current assets over current liabilities. So I just need to mark my current assets and my current liabilities and find the current ratio. I have been given information about the current assets and current liabilities over here. On 31st of January 2019, I have been given information about my current assets. Inventory is current assets. Trade receivables is current assets. Current liabilities. Bank loan is current liability. Cash at bank current assets. Cash in hand current assets. I need to calculate my current ratio. Formula for current ratio is current assets over current liabilities. So I will write all my current assets, 31,200 plus 3,900. Current liabilities is 32,000. Current liabilities of short-term bank loan 10,000. Cash at bank 14,000 plus 100. So this becomes 76,200 upon 42,000. So my current ratio is 1.8 is to 1. It is very necessary to write this is to 1. Okay. Now, quick ratio. Formula for quick ratio is current assets minus closing inventory over current liabilities. So my current assets was 76,200. My closing inventory is 31,200. So I will minus this 31,200 over current liabilities, which is 42,000. So I will get my quick ratio as 1.07 is to 1. Okay. So this is just putting the formulas. State one reason for change in the quick ratio or for the change in the asset test ratio. Why will my quick ratio change? What is the reason for the change in quick ratio? Just check. I found out my current ratio over here. which is 1.8 is to 1. I found out my quick ratio 1.07 is to 1. What is the reason why my quick ratio has fallen down? First, my current assets was, my liquid assets was 1.44 times the current liability. Now my liquid assets is 1.07 times the current liability. That is, my liquidity is decreasing. What is the reason why the liquidity is decreasing? It may be because I am receiving late payments from my trade receivables. That is why my liquidity is decreasing. What else could be the reason why the quick ratio is decreasing? So quick ratio decreases if there is an increase in current assets, or if there is a decrease in current assets. You can write the name. The quick ratio is increasing because there is an increase in inventory. Okay, the quick ratio is decreasing. Quick ratio is decreasing. Basically, your liquid assets is decreasing. The liquid assets is decreasing because there is an increase in the inventory. So that is why the liquid assets is decreasing. Or maybe you are receiving delayed payments, or maybe you are doing more cash expenses. You are doing more cash expenses. You are repaying your loan. That is the reason why your quick ratio is decreasing. Let's look at the next part. The directors are concerned at the change in the quick ratio. The directors have made 4 proposals, which according to him would increase the quick ratio. Put a tick in the correct column to indicate the effect of this proposal on the quick ratio. First proposal is buy a non-current asset on credit. If I buy a non-current asset on credit, that means the asset NCA would increase and my current liability would also increase. If liability increases, the quick ratio will decrease. Liability will increase current liability, so quick ratio will decrease. Sell on cash terms, then on credit. If I will sell on cash terms, inventory will reduce and cash balance will increase. Inventory will reduce. Inventory has no effect on the current assets. Cash will increase. So one current asset is reducing, one current asset is increasing. So it will have no effect on my quick ratio. Arrange for short-term loan to be changed into a long-term loan. If my short-term loan gets converted into a long-term loan, that means my current liability is going away. If my current liability is going away, that means my quick ratio will increase because current liability is decreasing, so quick ratio will increase. Pay the credit suppliers more quickly in order to obtain cash discount. Current liability is reducing, quick ratio will increase. So this proposal will increase the quick ratio. Explain how proposal 3 would affect the current ratio. If quick ratio is increasing, current ratio will also increase. In proposal 3, your short-term loan, what is happening in proposal 3? Short-term loan is getting converted into long-term loan. So if the short-term loan is getting converted into long-term loan, current liability is decreasing and current assets have no change. If current assets have no change, your current ratio would increase. Let's take, for example, suppose if your current ratio, current assets over current liability was 20,000 upon 10,000. If you convert your short-term loan into long-term loan, and if say it was 5,000, so this will become 20,000 over 5,000. So the current ratio will not explain how proposal 4 would affect the current ratio. Say for example, if your current ratio is 2:1, or say 20,000 is to 10,000. Let's see your proposal for pay the credit suppliers. That means I'm going to pay the credit suppliers. Maybe I pay them 4,000 instead of 4,500. So my current assets would reduce by 4,000 because I paid them 4,000 in cash. But my current liability will decrease by 4,500 because I got a discount. So my new current ratio would be 16,000 over 6,500. So the new current ratio will increase. So the proposal for would increase my current ratio. You can always take an hypothetical example to see if the current ratio is increasing or decreasing. Even over here, you can try it with an example. So this is the question that is asked in March 2019 related to ratio. After this, you can try another question, which is March 2016 paper 22. It is related to Annie.